if you have that kind of business model in which your growth is not based on giant burn rates, huge permanent dollops of capital, if you belong to that category, then you are very well off listing as early as possible.
Fair
In
enough.
my view, a small investor should not become the, let's say in Hindi we say bali ka bakra. This burn rate nonsense has been propagated by venture capitalists. So it is this vicious, incestuous cycle that the VC wants you to burn more. The founder doesn't want to get diluted. Therefore, the VC bumps up the price, knowing this is not the price. This is not the valuation. Remember, when an investment goes wrong, it is not because you were necessarily at fault. Simply, companies make bad decisions. You are going to lose money 100% of the time in trading. Yes, my biggest mistakes always happened when I became extreme in my thinking.
Hi. In today's episode of the KVKurious Podcast, we have Shankar Sharma, who is the Vice Chairman and Managing Director of First Global. Shankar is a seasoned investor with 3+ decades of investing experience. And in this conversation, Shankar shares some of his learnings from the past, some things that he may have done right, some things that he may have done wrong, his learnings from his mistakes, and in general, tips for retail investors. Shankar also shares some extremely incisive thoughts on whether startups should raise capital from VC firms or whether startups should list early in the public markets. And if you're building a startup, what do these approaches mean for you, and how do you choose between these two approaches? And more importantly, Shankar also shares some anecdotes, some personal experiences and perspectives on preparing and striving for long-term success in life. I hope you enjoy this conversation with Shankar Sharma on the KVKurious Podcast. Hi, sir. Thanks a lot for being on my podcast, especially on a weekend morning. I really appreciate this. Curious to know more about the markets worldwide, the scenarios now. What's the option and what's the future for retail investors, and what do you think should be the future of startup worlds in general? But yeah, we'll start off from your journey with investing. Thank you. Thanks a lot for being here.
Sure. Thank you.
Yes, sir. So maybe do you want to talk about what exactly is happening with the Adani event right now, and how do you think it's affecting the macroeconomics, but still not affecting the markets as such? And there's a lot of reports that we're reading in terms of how markets are the best decision makers, and it's not necessary that government should involve in things like that, but people will always arrive at the fair price and arrive at the fair decision for whatever is being done by a company. What is your take on that, sir?
Zero effect, nothing.
Exactly. And why do you think that's the case?
Why should it affect anything beyond its own set of companies? I'm sorry. Explain why you think it should affect anything beyond its own 5, 6, 7 companies, whatever other listed companies. It is one company. There are 15,000 companies in India. I mean, when Enron and WorldCom happened, what happened to US? When Wirecard happened, what happened to Germany? Nothing. These things keep happening. Some problems, Satyam happened. What happened to India? Nothing happened. So I find it very, very offensive when people start to think that the fortunes of one group will affect the fortunes of a large nation like India. And I say, then you are demeaning, insulting India. There is no other definition. This is an insult to India if you start equating the fortune of one group, no matter what that group is, whether it's even Reliance or the whole IT sector or Mahindra group or Adani group or, Munjal group or whatever group you have. It does not matter. So I find it extremely offensive when people start to equate the fortunes of India with the fortunes of a single business group, no matter which group you're talking about.
Got it. So regardless of the market capitalization of the company, what we kind of understand is the markets is far beyond just one company. It's the culmination of 5,000 plus companies.
What was the market capitalization of this group 2 years back?
True. Very low.
So how does it matter? Worst case, it can go to that market cap. So what will happen? Was the Sensex at 10,000 at that time? Nothing.
No. Yeah.
So nothing has happened. That the data is telling you. Sensex was 61,000. It's still 61,000. I mean, these are all irrelevant issues because people start to play the nationalistic card and say that it will affect India and hence this and that. If India starts getting affected by individual corporate problems, then we are not worth calling ourselves a country. Then we should start calling ourselves a company.
Right.
India is not one company.
Right. So maybe switching gears here, sir. Just curious to understand, how did you get into investing in life? What's the journey with First Global? How did you get into this play of markets?
So I made my first investment in 1982 when I was a teenager, and I made it more out of chance. Sometimes things happen without any logic, and somebody just told me that you should make some investments in the stock market. Back then, it was the very early nascent years of the stock market in India. But still, there were good companies like ITC and Levers and Reliance. All of them were listed at that point in time. And I managed to get allotment of a new issue for Asian Hotels, which was a Hyatt Regency chain of hotels in India. And I got it at par value. And I made some money. It was, I think, 200 rupees after a few years. And that kind of sparked the thinking in me that, this is a good way. I mean, I never thought of it as a career, but at least I got to start believing that, this is a good money-making option, even if it's not my main career. And then after my MBA, when I came back to India, I was working for a bank, and that was 88, 89. And I just I just took a call that India, wherever it is at that point in time, would become a huge market 10 years out, which was year 2000. So I said it's the right time to jump in. It's the right time to jump in and go all in, go out on the street and, try and build investing, broking, and all of advisory as a business instead of just remaining in a job and doing this on the side. I was very clear that India was going to be a big stock market and a big liquid thriving country. And I wanted to get in on the ground floor. And I was in my mid-20s. I was, I think, 26 or 27 when I left my job in a very, it was Citibank, the best bank in India back then, the number one job for any MBA, living the good life. I was living in a very nice place in Mumbai. Back then was Bombay. Life was great. I mean, I could have continued like that. And, life would have been good, but I decided to take the plunge because I was very convinced that India was going to be a fantastic country and a fantastic stock market to bet on.
But back in the 90s or, just in 1990, 89, 90, like you mentioned, the markets was in very nascent stages. What exactly gave you this conviction at that point that India is on a growth trajectory and this is going to be big?
Well, that's sometimes you get some line of sight that, this is going to be big. And there is no real rationale because you are sitting in your mid-20s. There is no internet. It's not that you can analyze many things. It's simply a call. It's simply the calling that, and India always had a good stock market. In my view, India's biggest advantage as a nation has been an entrepreneurial energy coupled with a very strong stock market culture. And this goes back from the early 70s, or in fact, the late 70s, when Reliance did its listing. Since then, it's spawned an equity culture in India. It was still small, but rapidly growing, which almost no other developing country has had this. So by 89, when I left my job, India was a decent market. It was not like, a tiny little market. It was a good, thriving stock market. I could see that it would just keep growing to a very large level in the years to come.
Interesting. Yeah, and turns out your call is completely right. And today we are sitting on a very strong stock market, and the world is looking towards India with with a ton of optimism. So, uh, but when you say that there were these early movers who were listed back even in the 80s and 90s, and most of these were the current FMCG giants, if I may call them so, or at least the last industries per se. And not a lot of these were typical or conventional startups the way we see today. And now, of course, I mean, we could talk about how do we distinguish between a startup and a business. But I heard in a recent interview where you mentioned that companies like Amazon, Facebook, Google, etc., went IPO early, and that's possibly one of the biggest advantages they had when they were listing, as opposed to IPOs in India today. Uh, what do you think is the significant advantage of listing early, especially as startups in India?
Look, there are two kinds of startups. One is a startup with a good business model, which does not require huge amounts of capital to grow. And if you have that kind of business model in which your growth is not based on giant burn rates, huge permanent dollops of capital, if you belong to that category, then you are very well off listing as early as possible. As early as possible. Because the stock market loves companies that don't generate huge cash burns. It loves companies which have some cash burn in the initial years, that is to be expected, but not exorbitant like what we see in the commonplace startups of today. So all of the companies that I mentioned were good business models, robust business models. And hence they were well off and better off listing early, because then they allowed their entire corporate journey to be captured in the listed markets by average small investor rather than a bunch of private equity or venture capitalists. So they gave the opportunity to every small investor to become a venture capitalist. Okay. And there is no reason why a small investor should not get that opportunity. In my view, a small investor should not become the, let's say in Hindi we say bali ka bakra, that you just fatten the sacrificial lamb and slaughter it and give it to the retail investor. That is the wrong model, and that is the model that all startups have followed when the VCs have captured most of the returns, and then they dump it on the retail market in the IPO through the IPO route. That is never going to work, and we have seen the disastrous results of such a strategy. So I have said very, very clearly, great companies, if you have a good business model, please list early, list within 1 year, list within 2 years. There is adequate appetite in India because Indians love to give capital wherever they expect a long journey of returns. It may or may not happen, but at least give them the opportunity. 10 such companies coming out, maybe 5 such companies will lose money for investors. That's fine, accept it. But in the 3-4 that they will make money, they will make such a huge amount of money that the losses of the 5 that went bad will be more than adequately covered. And that is the way venture capital works. No venture capitalist makes money in all the investments they make. Okay, they make money in maybe 20-30%. So if a retail investor takes the same percentage game, and you bring good companies to the market at a very early stage, you are giving them the chance to ride the entire journey. The Infosys, the HDFC Bank, the Google, the Bharti, they all listed within 2, 3, 4 years of their corporate lives. They didn't list after 10 years. Because after 10 years, the entire growth has been taken away. The headroom for growth is much, much less now.
Right. But let's say a company has started off and is initially profitable. And let's say by company, I mean a startup is initially profitable and they choose to list. And let's say the business model is robust. But in order to scale this to just grow the user base, it might be the case that during the growth phase, they might have to have a slightly higher burn rate, although they were profitable as a company at the small scale.
I don't agree. I don't agree.
Okay.
I don't think good companies need huge burn rates. I totally disagree.
But even if not a huge burn rate.
This burn rate nonsense has been propagated by venture capitalists. It does not require. It is not required. Great companies don't get built in one day. Venture capitalists want a baby to become Arnold Schwarzenegger in 2 years. Oh, that's ridiculous. Companies are not bodybuilders where you can pump yourself full of steroids and become a giant. It doesn't work like that. There are systems, processes, thinking, strategy, challenges, modifications of your approach. All of that cannot be a 10-year journey, cannot be compressed in 2 years. And when you try and compress it, you get burn rates because you're trying to artificially accelerate the growth.
Right.
So this whole paradigm has to change. Great companies are built over time. Great companies cannot be built in a matter of 2 years' time. No way. But the venture capital, they want it to be done in 2 years because they have 7-year funds or 10-year funds. That's it.
But do you think
the market is willing to fund your losses? There is no problem. Amazon was loss-making for, I think, a good 7-8 years after it went public. Jeff Bezos was very clear in messaging to the market that, look, I'm investing for the future. There will be losses. And whoever is investing, please invest with a long-term perspective in mind. And, through the journey, he was very clear in what you are going to get. Don't expect me to be profitable from day one. So there are ways, you can message to the market that you are acting as a venture capitalist. So be patient. That's it.
Got it. But don't you think, or let's say, do you think that markets will punish you harder in case you make, any mistake during your growth phase, and it's easier to sort of recover from that mistake if you're dealing with venture capital?
Yeah, sure. That's fine. But in my view, there are two journeys a company can take. One is an unlisted journey. Okay. The other is a listed journey. In an unlisted journey, if you go down that path and you're free to do that as a company, you will inevitably find a hard time getting listed. And that is because the valuations in the unlisted market are like this. The valuation for same or similar company in the listed market is like this. So once you go on that journey, there is no coming down to this. It's like two divergent tracks. You choose your track. Okay.
Right.
I mean, Mama Earth, do you think any rational FMCG company can trade at the multiples they want? They're ridiculous.
Yeah.
And if retail investors buy it, I think the biggest fools in this planet will be Indian retail if they subscribe to this kind of offering. I'm not making one case for this company. They were idiots to have subscribed to even the earlier ones. They have paid a price for it. So you choose your path. If you go down unlisted, remember, you will probably never be able to list because none of these valuations are listable valuations in the IPO market anymore. There was a phase, you exploited the phase, these 4-5 companies came and exploited that phase. That's over. You can fool somebody once. You can't keep fooling people all the time.
Right.
On some bullshit metrics and this and that. So yes, you're right. The VC market will be more patient. Go down that path. No problem. But remember, you will not then get an exit through the IPO market. Because I see companies making $5-10 million of revenue getting valued at $10 billion. Valuations is 2,000 crores, 2,000, maybe 3,000 crores of revenue. That to all kinds of, I don't know what kind of numbers these are. These are all smoke and mirrors. Assume for a minute that they are genuine. 2,000, 3,000 crore revenue, 3,000, maybe something like that is the loss. And the private market value was $40-50 billion. I mean, are you out of your mind? This is ridiculous. Which listed market stock can ever trade like this? So you remain unlisted. You find an idiot to buy your entire holding as a founder, go home and retire to whichever part of the world you want to retire. So there are two divergent paths. Choose your path, but then remember that path then is your permanent path. There is
Permanent
no
path.
crossover allowed. It's not possible. In the listed market, markets are going to be more demanding. Okay, that's a fact. So you have a choice between what approach you want. If you have a decent business model, like I said, I repeat, which doesn't require huge cash burn, okay, please be listed at ASAP. If you have a crap business model that requires huge dollars of capital, please go down the VC route. But remember, you cannot ever come back into the listed market. Nowhere close to the valuations you want. No way.
Right. So you mentioned about how the valuations in private markets do not make rational sense, at least from the public market perspective. So how on a personal level?
Let me explain. Why don't they make sense? That's also an important thing to understand.
Yeah.
They don't make sense because of this. So you have a company which is whatever selling, food delivery services or whatever it's selling, right? And if it were to grow at a normal pace, it would make a loss of 10 crores a year, roughly, for 4 or 5 years. You wanted to grow very fast, so the loss will suddenly balloon to 500 crores. Okay, so the VC says, I want you to grow really fast. So you as a founder say, but I'm going to make a loss of 500,000 crores. No problem. I will give you the $200 million or the $1 billion or the $500 million. Done deal. I will give it to you. So the founder says, but if you give me that capital, I'll have next to nothing left in the company. I'll be totally diluted. VC said, no problem. I will bump up the valuation to $1 billion and I'll give you 200 million. So now, it's fine. So I'm just taking 20%. So it is this vicious, incestuous cycle that the VC wants you to burn more. The founder doesn't want to get diluted. Therefore, the VC bumps up the price, knowing this is not the price. This is not the valuation. VCs are not idiots. They've all got Harvard degrees over. I'm sure they teach you this in Harvard. So they bump up the valuation to crazy levels to justify the amount of capital they need to put in without diluting the founder down to zero. That's the whole chain. If you connect the dots, that's how this game works.
So as an individual, as an investor, how would you approach estimating the fair price of a particular startup or the fair valuation of a particular startup?
There is no such thing. I mean, you will still apply in the beginnings price to sales multiple. Okay. And eventually you will apply a price to earnings multiple. Okay. This will be a journey when the price to sales will converge to a price to earnings multiple. What price to sales? It again depends a lot on individual companies, whether it's tech, non-tech, old economy, new economy. There are many, many factors involved. But ultimately, these will be judgment calls. They will not be, completely defensible down to the last dollar that, okay, this is the correct price. You have just broad estimates. That's what startup valuation is all about. Now, the broad estimates can be within a channel or they can be very wide. Okay. In my view, as a startup founder, like I said, if you want to be reasonable with your investors and you have a good and a decent business model with some profitability, go listed, give retail investors a decent chance to make money, because that becomes a huge source of capital and stability for you. Venture capital, private equity is a very volatile market. In a bad market, they will desert you. Retail is generally very, very loyal, very, very loyal. If you give them something good, they will be well disposed. They will keep giving you capital for a long period of time. So again, there are pros and cons to everything. There is no one holy grail. Valuations can be all debatable, but there are broad thinkings that you can have as a founder.
Got it. But one distinction I find between public and private markets is in private markets, especially early stages, people tend to build a very elaborate portfolio, large number of companies, so that even though majority of them may doom, the few successes is going to compensate for them all. But in private markets, especially for retail investors, the most popular recommendation is that keep your portfolio as small as possible, and just be diligent about picking the companies, and you might have a better chance at making money. Why do you think this distinction is? And would you agree that retail investors are better off maintaining a smaller portfolio?
No, I completely disagree with the notion that in listed markets they should maintain a small portfolio. In fact, they should have a minimum 30 stock, if not a 50 stock portfolio, because the principles of investing don't change much between private and public. The difference is in public, you have more disclosures on an ongoing basis. So it's a better field of play with more governance and, accountability. But it doesn't mean you will go to 5 companies or 8 companies. It doesn't work like that. Statistically, you're still better off choosing from a larger basket and then bringing down to 20, 30 holdings. And over time, you will find that the better ones are, breaking away from the pack of your 30 stock portfolio. It's like a marathon race when you see everybody starts out same, and then after 5-10 kilometers, there's a bunch of runners right at the top, and then the big bodies in the middle, and then there are the laggards right at the back. That's exactly the way your portfolio is going to behave. It's not that all of them are going to be running at breakneck speed, or all of them are going to be terrible. Just statistically, if you've chosen well, you're going to be finding that out of the 30 stocks, maybe 4, 5 maximum will be breakouts. They will be doing phenomenally well quarter after quarter. They will become your lead runners. But you cannot start out thinking that you will find those 5 and be only in those 5. It doesn't work like that. Life is not that predictable that we can see so much ahead. No, Jeff Bezos or any other founder had no idea how big they would become. And for one success like Bezos, there are thousands of failures who also believed they would do very well, but they never, managed to do it.
Got it. So as an investor, how have you maintained your portfolio so successfully over the years? For you to continue 30 plus years in the business, what is one thing that you did right at every stage of your career?
No, I didn't do many things right. I mean, I want to be very clear. It's not that, one was doing things right from the time I started. One made many mistakes. What I'm telling you is the net finding of 30 years of investing or trading experience, that in the beginning you believed this wrong notion that buy just a few stocks and go with them and all that. I mean, that did not work, and that does not work. It works only out of sheer luck and nothing else. And I was just doing the back of the book comment for a book on Rakesh. And I was flipping through the book, and one of the interesting things in that book is that he bought Titan in the 80s. Okay, and that was something I did not know, in the 80s. And he nursed a bad investment for a good 16 years because there was no exit. The price from which he bought, the price had fallen by 70-80%. Now, obviously, very hard to take losses of that kind. So you just keep it. You've forgotten it. It's just one part of your, cupboard. And then after 15, 16 years, it comes back and becomes a great company. And it was a terrible company for a good 14, 15 years. Now, hey, that's luck. There's nothing more than that. So if you get that lucky, don't start thinking that you'll keep getting lucky like that. You'll find one such stock if you are blessed, lucky, God has bestowed, a lot of blessings on you. Most people will not get that kind of, statistically, out of 1 crore investors, maybe 5 will get such a lucky break. Most people will have just junk in their cupboards. Okay. So the fact of the matter is, you don't start out thinking you'll buy the best 5 companies. You start out thinking I'll buy the best 30 companies. And then you will find 5, 6 great winners. And this is a learning. This is not something that I discovered right in the very beginning. Okay, I just want to be very clear. The 30 years is only a series of mistakes, but you don't repeat the same mistakes.
Right.
The only thing I always say is, We will all, even today, we will make mistakes. That's okay. It's like I'm watching Test cricket and you will see a great batsman getting out to a delivery he should not be. And these are cricketers who have played 100 tests. They will make mistakes. They're human beings. It's not that every innings you're going to get 100. But the point is that learn and do not repeat.
Right. So
Only idiots repeat the mistakes. Find a new mistake. No problem. Don't repeat the old one.
So, as an investor, how do you pick your portfolio, sir? I know this is probably a question you've answered multiple times across spaces, but do you sort of study more about the team, the fundamentals of the company, or are you sort of more of a trading perspective where you look at the technicals and say, okay, this may be going to perform in the short run, and maybe I want to make a quick buck here, or do you always invest from the long-term perspective?
No, so it depends on the life stage at which you are talking about. When I was young, I was a trader because most of us never had the capital to invest. In people say become investor, but I mean you need capital to invest. And so I mean back in the 90s, we didn't have any capital. We would only buy stocks in F&O, the equivalent of F&O back then, because you had no money to put up for the entire purchase that you wanted to do. So, but today, I'm investing not ever for just a quarter or something. I mean, I do look at technicals. That's an important consideration. But I will not trade based on that. I will not invest based on that. It's just a good, broad perspective of where the stock is relative to its history, relative to peer group and everything. But definitely a minimum year's view, because I don't have visibility for any company beyond 1 year. If anybody says that I have 5-year view on a company, I mean, I say then you're just being very, very arrogant, because I have no such ego to tell me that I have a 5-year crystal ball. I have a 1-year crystal ball, which works reasonably well, but still I will evaluate everything as I keep going, quarter to quarter, numbers, commentary, everything. I mean, all that we do on an ongoing basis for every company. But again, remember, there are no sure things in investing, and most investors or small-time investors, first-time investors, think that we have done this 30 years, so we'll not make a mistake, 100%. It's not going to work like that. It just doesn't work like that. Be humble in this game, that there will be errors. And remember, when an investment goes wrong, it is not because you were necessarily at fault. Simply, companies make bad decisions. Now, how on earth can you as investors foresee the bad decisions that a company will make 2 months, 6 months, 1 year out? You have no idea. So when an investment goes wrong, I only evaluate it from the perspective that, was it something I made a mistake in terms of not having seen this risk? Or is it something that happened subsequently, in which case it's not my fault? I mean, things change, businesses change, mindsets change, and I can't predict all of that ahead of time. So distinguish between good mistakes and bad mistakes. Bad mistakes is when you should have seen this risk and you did not. That, with experience, you can minimize. You can minimize that a lot. But the rest of it is all up in the air.
Got it. But when you speak of this 1-year horizon that you proceed with investments, you recently made an investment in Drone Acharya, and that was something was listed in the SME space. And at that point, at such a small scale, how did you foresee that this company, as a drone startup, is going to do so well?
Again, judgment calls. There is no. Like in startups, it's largely an art, not a science. You need to just imagine the possibilities of what this company or what this founder can deliver. And again, remember, it's not that Dronacharya is 100% of my portfolio.
Oh, for sure.
Okay?
Yeah.
So that's my job, to invest in a number of companies. I hope all of them do fantastically well as Dronacharya has done. But I'm also mindful that some may not. But the startup part of my portfolio is very, very small. I do not do startups. Dronacharya is one of the rarest of rare companies that I have invested in as a startup. I mean, I typically have avoided for the last 20 years investing in startups because I don't understand that space at all. I believe in buying some things with some degree of clarity. I will not have 100% clarity. But in a startup, there is no clarity. It's a journey into the wild.
Right.
And I don't like to make such journeys. That's dedicated for venture capitalists. I'm not a venture capitalist. So Dronacharya, as a company, in my view, will do very well. At the same time, as a category, it's a very small part of my overall, thinking and my overall, funding.
Got it. But one other thing is, in the last 2 to 3 years, we've noticed a number of startups coming in there, at least in India, that is focused on allowing more people to invest more easily or participate in the markets more easily. What do you have to say for these startups, let's say StockGrow or Three Dots, companies like this that are trying to bring in more people into the markets? Do you think people are not in the markets because of lack of capital, or because of lack of their risk appetite, or just because of lack of awareness?
I think there are 10 crore demat accounts is enough indication that a lot of people are in the market. If you look at 10 crore accounts in a country with the level of income that India has, I think this is fantastic by any standards. So I don't think, India is very lacking. It was lacking 20 years back, not anymore. I mean, there's a very good penetration of demat accounts, and therefore, individual stock investors, whether directly or indirectly, these startups have helped that to some extent because they have invested in marketing and bringing the equity culture down to a very small person. And that is enabled through internet. I mean, internet, faster internets, 4G, 5G, smartphones, all of those things have contributed to not just stock investing, but online shopping or, e-commerce and stuff like that. It's just part of the investing piece is just one big e-commerce piece in the overall e-commerce pie, which has expanded thanks to, faster internet.
Got it. And what do you have to say about crypto assets or crypto? I wouldn't say cryptocurrencies, but let's say crypto assets. Do you think people should have it as a part of the portfolio? Do you think it should be dealt with as an asset or as a commodity or as a security? What exactly?
And if you want, you can keep it as a small piece of your investment. I don't think more than 1 or 2% is deserved or merited. It's a very volatile class. It will remain for sure. I don't think it's going to go away. But should you be putting 40, 50% in it? I mean, I think you will be absolutely a nutcase to be doing such a thing. Ultimately, stock markets have endured the test of time. In the stock market, you can get fantastic diversification across the entire risk spectrum, from the least risky to the riskiest. You're spoiled for choice in the listed spaces, whether in India or elsewhere. So if you do want to go into crypto, put a small part and do no more than that. I mean, that's my broad macro advice. I mean, nothing more than that.
But living in Dubai, which is at this point seems like the hub of most Web3 activity happening, what do you think is exciting about this space, or is worthy of exploration in the space?
Well, I mean, I don't spend too much time on it. So I don't attend webinars and conferences on crypto and all that. I mean, that's not my space. I mean, I look at the prices, I know what's going on, but I don't waste my time into this because I have enough and more opportunities in the traditional listed markets. So again, it's about time. It's return on time, because that's most important. There are many things in this world you can do, but I tend to focus on things that are easy to understand, something I've done for a long time, and something I think I am reasonably good at.
Got it. And again, drawing back to your initial days in investing, when you mentioned that, and it's also true with sort of the demat accounts penetrating across tier 2, tier 3 India, a lot more of younger people who are now into investing, who do not have capital, try to get into leverage options, right? Which is extremely risky. So do you think there is a way that people can choose to just hedge their risk in case they are going for very riskier approaches in their early days?
I don't think they should be doing it in the first place.
Doing it as in taking the leverage?
I don't think people should be trading.
Okay. Then how else is
Nobody's
one
going to
supposed
make
to raise
money.
capital?
No, I mean, I don't care. That's not my problem. Figure it out. But you are going to lose money 100% of the time in trading. There's data. You can see that. SEBI has published it. Nobody makes money in trading. It's impossible. Impossible. Just simply impossible. So forget it. It's not going to happen. There's no point giving advice on somebody bent on committing suicide, that what is the best way to commit suicide. Okay? There is no best way. Just go and do it if you want to do it, but you will die 100%.
Got it. But this just begs me to ask this question. Zerodha as a company dwells on the model where it makes money off intraday investors, right? They charge a fee from intraday investors, intraday traders. But if trading was such a stupid activity, why do you think, although a very small percentage of the market, maybe 3 to 4%, is accounting for, let's say, 95% plus in terms of volumes? And why are so many people still in this game, although it feels like a suicide?
Get rich quick. This is the age-old lotteries, scams, Ponzi schemes, chit funds. People.
But by and large, you think everyone's going to fail in that?
The data is there. Everybody is failing. Zerodha themselves have put out the data. Less than 1% make money. And that to what money, we don't know. 99% lose money. I don't have to say anything other than what the data from SEBI or from even the brokers is.
Got it. And what is your outlook for India for the next 1 year, sir? What do you think are things that is extremely promising about the country from startups point of view, from companies point of view, from capital point of view?
Look, I want to say one thing. India has always been a land of promise and opportunity. Always. From the time I was born. Given that there was so much headroom in everything, where developed countries were and where India was, the gap was staggering, and it still is. We are $2,000 per capita. Developed countries are 50,000, 60,000. We can keep growing for 100 years and still not be able to exhaust our potential. China itself is $12,000, $15,000, which is our nearest comparable. So India is permanently a land of opportunity. Not today, not yesterday, but from the times we became independent. Because it has every ingredient to be successful as a nation. It's just that, we started out at a very low base. And from there, we have progressed. We will keep progressing. We have big population, which in my view is the single biggest factor in determining your long-term growth as a nation. China, US, India, all three have large domestic population, which is so important because that gives you a domestic consumer base. Countries like South Korea or Taiwan, Thailand, Indonesia, the previous Asian tigers, had very small populations. So there are limits to what domestic growth can deliver. They will depend only on export markets. And that can be problematic. That's the same with European countries. They are generally very small in terms of local population. So hence growth hits a wall moment the population starts to age. So India's big advantage is huge population, young population, good stock market, entrepreneurial energy. I think India will just keep doing well. I saw this when I left my job to participate in the Real India story in 1989. Okay, it's not that I left today. I left, 33 years back because I saw a future which was very bright for entire India. And even today, I can see the same and similar future. So why talk 1 year? You can talk 5 years or 10 years. There will be ups and downs. That's part and parcel. But the trajectory is solidly upwards for a country like India. It ticks all the boxes.
Got it. And if you were, a fresh grad out of college, maybe 21, 22, what would you be doing today, sir?
I'd be working hard. I'd not be doing the stock market. I'd be doing...
And working hard. Would you want to elaborate a bit on that?
Either get a good job, get into If you can get capital, become an entrepreneur, do something. The stock market should be an outcome of all those endeavors. Most people think that stock market should be their only business. That's not going to work for most people. I can tell you this. Okay. Again, we were one of the lucky few who made it while putting an all-in bet. Again, don't look at us and make your view of what life is going to be for you. Don't look at Rakesh's Titan investment and say that you will find your Titan. There are so many things around that you do not know, that could have easily tilted it from a fantastic investment to a terrible investment, from a fantastic career to a terrible career. I mean, all of those things we don't know. We just look at the net result and we want to copy that net result. So it's not going to work. Do something which is more fundamental. Stock market can wait. That's my simple advice.
Got it. And from your investing journey, do you think there is one thing at any point that you did extremely terrible that you wish you had done differently, sir?
Yes. My biggest mistakes always happened when I became extreme in my thinking, which means either extremely bullish, extremely bearish. And that was again part of the maturity cycle that all investors should go through. That now I'm a more balanced person over the last several years because I've seen more of the cycles, ups and downs of markets. Nothing is permanently good, nor is anything permanently bad. And therefore, I cut through this highs and lows and keep a very steady, try and keep a very steady head on my shoulders, which evens out the emotional highs and lows, because a lot of investing is also how you manage your own emotions, your own thinking. It's not just managing your portfolio. The biggest portfolio is here, how you manage your own thought processes. So as you grow older with more wisdom, more cycles, more losses, more mistakes, you tend to become more balanced. I mean, it's almost like being in Zen. Today, when a company I own does very well and it makes a lot of money, I don't throw a party or I don't, start jumping for joy. Nor do I start crying if something loses me money. I'm more like a Zen master today. Earlier, I was more like a ninja, if you understand the difference.
Sure. But since you mentioned this play of emotions here, typically what happens is, at least with people who have freshly started investing, as let's say you buy a stock and the price dips a bit, you just are very hopeful that it's going to pick up someday, and you just wait and wait and wait until it's gone down, let's say 30-40% below, and at that point you just don't know what to do. So and I know this because we recently did a survey and we found close to 60% of our respondents mentioning this as one of the key problems. How do you think should one deal with this emotionally and recover from this loss?
In my view, very simple. 25% should be your stop loss. I keep that even now. Don't lose big money. As long as you protect your capital from severe drawdowns, you will win and laugh all the way to the bank.
So the key is to always fix your stop loss and keep it low.
100% of the time.
Okay, sure. And any one concluding piece of advice to entrepreneurs in general, at least based in India, and more broadly to retail investors?
To everybody in business, investors, my simple advice is, please invest first in your own self. Build this up big time. Build your personality up. Build your communication up. Build your knowledge up. Build your body up. Being successful in life is a whole package. Your physical, mental faculties and capabilities have to be at the best that they can be. Don't be a fat slob, okay, unhealthy slob, okay, sitting and eating junk food and drinking and smoking all day and saying that I will make money as an entrepreneur or as an investor. Sorry, even if you do, that life is not worth it. Okay? Or if you look like a fashion model, but you're a poor guy, again, it doesn't work. So invest in your thinking, build your knowledge, build your body, build your personality, build your communication. And you'll be surprised how easy it is to do all this. And you'll be also surprised how few people do this.
Right.
I'm always surprised why people are fit, why people can't talk well, why people, have no knowledge. They just don't understand any of this. It's so easy. Just one thing.
Got it. Thanks a lot. Thanks a lot for doing this, sir. I would say quite some incisive thoughts here. Really appreciate this. Thanks. Thank you for taking time.
Sure. Thank you very much for having me. You have a nice
Sure.
weekend.
You too, sir.